Index funds have become one of the single most popular ways to invest since they were introduced back in the 1970s, rising from a few millions of dollars worth invested to now over $6 trillion, and that's just within the US market itself. Passive index fund investing has overtaken actively managed funds in the last few years as investors have sought a low-cost, proven way of investing over the long run. And it's earned them millions of dollars and kept greedy fund managers from getting their hands on their hard-earned money. But what if one of our favourite ways of investing is broken and there was a better way, an even more profitable way to make money in the long term? An index fund, but with a slight twist. Well, of course, when I heard about these, I had to make a video and explore a little bit more to see if any of this was actually true. Can we really get better returns than our trusty old index fund can provide us, whilst not having to buy individual stocks and bury our heads in company financial statements? As usual, let's have a look at the data and figure things out. Okay, let me get the cat out of the bag. This newfound index fund that claims to beat the market is one that uses equal weighting rather than market weighting. Let's keep things simple. So you might already know that traditional passive index funds, ones that cover the S&P 500 as an example, will allocate their money depending on how large the company is inside of it. So in really simple terms, the larger the company, the bigger the share of the fund that will go into that business. In a typical market-weighted index fund like the famous SPY in the US, here is what $100 invested would look like. Right at the top, you'd have $7 in Apple, $5.83 in Microsoft, $3.21 in Amazon, and so on. Pretty simple to understand, right? In the top 10 companies, you'd have more than 25% of your entire $100 invested. And everything else would keep being spread out, all working down the list of how large the market cap of the companies are. Now, in an equally weighted fund, as you might guess from the name, we no longer care about the market cap of the company, and we don't care how big it is in relation to each other. In an equally weighted fund, every one of the S&P 500 companies would get the same money invested, which would work out around 0.2% of every $100. So 20 cents would go to Apple, 20 cents would go to Microsoft and Amazon, all equally if we were investing just $100. So in theory, this sounds pretty interesting because here's the main argument. With traditional market-weighted index funds that dominate the market right now, and most of us probably use somewhere, they keep just pushing more cash into the big companies. As the companies get even bigger values, more and more passive index funds dump money into the market as we invest, and that cycle just keeps continuing. And of course, the more and more passive index funds make up the whole investing market, the more impact they can have to move the stock market, potentially some might argue away from the true value of the businesses underneath, almost creating a bubble. A fund based on an equal weighting is more closely aligned to what you might want to call value investing, as it would sell those stocks which start to go on crazy bull runs, and it would buy the stocks which get sold off, even if they may have not deserved it from any bad results. In theory, this sounds great, and a lot of popular value investors like Warren Buffett himself would certainly argue that when there's a lot of fear and panic out there in the market, it's a great time to be a buyer and snap up those bargains. If you think about it, it does make a lot of sense. You invest more of your money in those smaller companies and the stocks that have a greater chance of actually 10x from here, compared to Apple, Microsoft, and Google, who, as much as they're great companies, aren't exactly going to make a huge move in any given year. The challenge is though, just as you might want to put more money into companies that might grow faster, the funny thing is that if the company does grow, you'll have to end up selling it as it will no longer be equally weighted in your fund. So it's a little bit of a catch-22. Before we talk about some of the pros and cons though, let's actually have a look at some real world examples here, because I did say that these really could beat the market, and that's no easy thing to do, as we all know, in the long term. Let's compare two of the most popular investments in each category. We'll use SPY as our S&P 500 benchmark, and we'll use one of the most popular equally weighted funds by Invesco, which has a ticker symbol of RSP. We've only got data going back to 2003 for this one, but here's what $10,000 invested and dividends reinvested would actually look like. Over that time period, we end up with $52,587 from our equally weighted fund. And coming up a close second, SPY would have delivered us $48,560. That might not sound like much, but that's 8% difference in returns around a full year's average stock market returns. Pretty good, right? So that's settled then. Sell all of our market weighted funds and just put them in these equally weighted ones instead? Well, not so fast. There's a bit more to look into. As with anything in investing, when someone might ask you a question, the answer is usually, well, it depends. One thing always certain though is if you do click the like button below, it does turn blue 100% of the time, and it really helps out small channels like mine. So on the positive side, equal weighting is not only good from a potential value perspective, as we've mentioned, buying companies when they get beaten down, it's also good from a diversification perspective too. The issue we have at the moment, if you want to call it that, is a huge amount of wealth is concentrated in the technology sector in just a handful of companies. And this means that all of us are really relying on these big giants to keep performing year after year to help our wealth grow. At the moment, if we look at the S&P 500's different sectors, here is what they look like when they're market weighted, and here's what they look like when they're equally weighted. On the market weighted side, obviously it's dominated by the technology sector here at almost 28% of the entire portfolio, then followed by healthcare and discretionary. If we flip things over to the equally weighted, we're seeing a very different look. Technology still makes up the largest chunk, but it's only just at 15.6%, and then the next sectors in order are actually industrials, financials, and then healthcare. It's pretty interesting how investing like this could completely change your portfolio. On one hand, with the market weighting, you're really relying on the big tech players, then on the other hand, you're a bit more spread out with all of your eggs across a lot more baskets. The real issue is the weighting justified? And that's where the big debate can come in. If the big tech companies earn their market cap just because they're big and don't deliver strong results each year, then you can easily see how a bubble would be formed, making these companies way overvalued. It really depends on whether or not sectors like technology remain to be the big growth engines and the future of the global economy. Looking a bit wider outside the S&P 500, is there any other data that might back up the findings that equally weighted index funds are better? Again, the answer is pretty much it depends. And it's all down to when you pick and choose data from. If we look at some global funds managed by MSCI, another index provider like S&P, here you can see that over a period of 25 years from 1994, almost every index, whether that was global, the US, or even emerging markets, gives you back slightly more returns if you'd picked an equally weighted fund. And remember that these are the average annual returns, so if we take that US one as an example, going equally weighted would have given you a nearly 1% additional return per year, which over the years can make a huge difference as your portfolio grows. However, remember how I said it's all down to when you pick and choose data from? Well, if you go to the latest fact sheet and look at MSCI's fund performance based on their global fund, you can see that the traditional market weighted one is actually coming out on top. It's beaten the equally weighted fund and turned $100 into $231 when compared to just $194. Again, these can be very big differences when you look at them over a long period of time. So what's the point of showing this? Well, it really depends on where your growth comes from. As you can see, the yellow and blue lines here stay very close to each other most of the time, and it's only really been since 2018 and then the drop in 2020 that's caused a huge difference in returns as those big tech companies and other large businesses have risen with some huge momentum and big earnings. By selling out of their winners every quarter, the equally balanced fund keeps missing out of those bull runs, whether they're justified or not. And this isn't the full story, there's still one major thing we've not really got into. Fees, charges, and taxes. Sorry, I know it might be boring, but it is your money at the end of the day. With any fund, as we already know, comes with its charges and costs. So we really need to make sure that we factor these in when we're investing. One of the biggest benefits that index fund investing has brought to us is lower fees. We've got some great fund options to invest in here in the UK with fees on ETFs like VUSA being just 0.07%, but over in the States, they've got even cheaper offerings like VOO, which is an S&P 500 ETF and has fees of just 0.04%. As you might guess, high fees are bad for investors most of the time, but I'm sure we'd all happily pay higher fees if we got better returns. I mean, I know I'd pay 10% fees every time if someone could get me 30% a year, but maybe in another universe. Back in the real world, we want to keep fees as low as possible because those equally weighted funds need more management and don't have as much money inside of them. Their fees can be a lot higher and they can also cost you more, especially if you're not careful what kind of accounts you hold them in. As the equally weighted funds have to balance out their winners, they cost themselves more and more fees in transactions which ultimately get passed down to you. For some context, the Invesco equally weighted S&P 500 index fund costs 0.2% in ongoing management costs. This is still cheap in relative terms, but that's still 5 times the cost of the VOO as we've just spoken about. The key question you'd have to ask yourself is, are you happier paying a higher fee each year, as you'd have to make sure you beat the market by at least 0.16% to cover those costs? And as we know, beating the market consistently over the really long term is not easy at all. So this has been quite an interesting topic, I think. It brings up a lot of those questions that we have to consider as investors. Is passive index investing going to cause itself more problems as more people use it and cause stock market bubbles? Possibly, but it does all depend on the market at the time. During a stock market crash, an equally weighted portfolio could do one of two things. It could actually fall harder than the market weighted one, as large, more established businesses with plenty of cash and strong moats weather the storm and get through it, as we've actually seen in the data. But then, it can also be useful if the market crash was concentrated in just a single sector like technology, for example. If the tech sector falls hard, then an equally weighted portfolio might actually save you and not drop as far because it was never exposed as heavily to that in the first place. So It all depends on whether or not you might think that certain companies justify their market caps. Are Apple, Amazon, Google and the rest delivering enough earnings back to shareholders to warrant their prices? Or do you think they're overpriced with loads more to come off and other sectors are being left behind or neglected for investment, like all of those amazing small and medium-sized businesses with one day maybe the next 10x stock? As with anything, it depends, and yeah, I've just said it again. Unfortunately, we don't know the best strategy to implement over the next 10, 20 or 30 years because we don't know what will happen and we're not in control over that part of the market. All we can do is stick to whatever plan we have and stay consistent with it. I'd love to hear your thoughts below. Don't forget to let me know, had you even heard of these before, or would you now consider putting some of your portfolio in them and going with them moving forward? For now, I'm more skeptical. I'll keep with the market weighted. There'll always be new or interesting ETFs that's hot on the market and everyone will keep talking about. There's one thing you can be sure of though, they'll always find a way to make more money from you in fees, so just be careful and don't fall into those traps. Anyway, with that said, thanks so much for watching. I'll see you in the next video, and as always, happy investing.